Hello and welcome to the SATV. Today I am very happy to be joined by Paola Rojas, Managing Director at Synergy Resource Capital. So Paola, it's really great to connect with you again here.
Hi, Amy. Really good to see you. It's been a while.
Yeah, absolutely. So maybe you could just start off with a quick introduction to Synergy Resource Capital for any of our listeners or audience that doesn't know about your group.
Sure. We're a corporate advisory and investment firm based in Sydney. We work with the buy side to identify acquisitions, mainly mining projects, and with the sell side to help them raise awareness. And we use social media in what I think is slightly unconventional way. At least it is. And we work with ASX, TSX mainly, but also private groups in the Americas and Australia mainly.
Okay, excellent. And so, as you mentioned, your work focuses significantly on overseeing M&A deals in the industry. So, are there any interesting trends that you're seeing with regards to M&A, or maybe any other funding trends that are kind of big in Australia's junior market?
I think one of the things that has kind of grown in attention in recent times is more on the it's part M&A, part funding, and all rolled into one, which are IPOs. So IPOs and listings. I think we're seeing a lot more cross market, so dual listings. So companies that were listed elsewhere are coming to the ASX, and all this from ASX are going elsewhere. I think that's becoming more of a trend. And I have a really strong opinion about this, because I think, and I know it's a little bit of a pipe dream, but I think companies should be listed in multiple exchanges. And of course, that comes with a lot of capital needs, and it's not free, obviously, to list in multiple exchanges. But I think that would give more options for investors, because we see a lot, and especially because I'm used to talking to people anywhere. Like sometimes people are, I don't know, in Europe, and they want to buy a stock in ASX, and it's you can do it, of course, but it comes with a lot more complications. So I think just the ability for investors, and not only sophisticated, accredited investors, but just the regular people that they want to, do something elsewhere, and it gets really hard. So, and expensive if you not always, but and for on the other side, sometimes if you're using all these exchanges that allow you to trade in multiple ones, of course they have all the conditions, and the deal, the movements of the market. Sometimes you get the market makers are going to know about what's happening, and there's a lot of discussion about whether that's ethical or not, but it is the way it is. So you get signals from there. So I think that's one thing that I'm seeing a lot more. We're seeing it a lot more in the sort of mid-tier to bigger company market, but it's starting to trickle down. US listings coming now, listing not first, but many as a second listing in the US, which traditionally hasn't been something big for the market. So I think that's a really interesting thing that we are really keen on see how it develops, and whether it becomes something really long term and not just a fad. It's driven, especially the US, driven because of Trump, wanting everyone there. So suddenly everyone, okay, let's follow this. So I think that's one that I see most predominantly. So in going to the M&A bit, I think one thing that I've been doing a lot lately was in connection to looking at models that explain where we are in the cycle. And one of the models that I found really, really interesting was one that the one by Lion Select, and they. I think I forget his name. We've never met, but I should remember his name. But he said somewhere that, and you can maybe find out the name. It starts with an H. Headley, yes. So Headley said that we were at 5 o'clock. So if and I was trying to see, oh, okay, so it's this making sense or not? And I think it actually makes a lot of sense. And we're seeing a lot of those mergers first. Like one example of those mergers, I think, is the Equinox Calibre, and I think that is kind of showing that the companies are trying to, take advantage of valuations that are good. They're like, for gold, they're kind of high, but they're not as high as they could be, especially looking at where gold is as price. So I think that's interesting. Of course, right now we're seeing a little bit of a pause because of just the summer in the north. But I think the moment, I think we're kind of moving towards 6 o'clock, which is the fun time. So I'm hoping that's the case.
Excellent. And, just to kind of continue on that, looking at cycles, I thought we could just shift and look at some commodity trends. So, what are you most excited about? What are you bullish about in the coming years?
We have a really, I would say, kind of strong long-term view for a few commodities, and as the three, gold, copper, and silver, to me they are just so intertwined that it's hard for me to kind of have a different opinion on each. But of course, copper, and not because they don't have different characteristics, but I think short term and long term, we're going to, like, it's just, we have to try really hard to make a bear case for those, I think. So for those, we have a short-term and a long-term view that these are just strong. We're going to keep building. Of course, copper has had, ups and downs, and we saw with the changes that we're kind of living in the US. I mean, not living literally because I'm not in the US, but we work with the US. So, it's you do feel it every day. The fact that that discrepancy between the LME and COMEX, that was so evident, but now it's sort of back in sync. So I think it was just kind of the market's trying to figure out how to get around that. But long term, I think that's, it's gonna stay. And then there's three other commodities that, well, they're nuanced. So those are lithium and rare earth. And we've started doing a lot of work in rare earths this year. And I think one interesting thing that I see, and after enduring in sort of the hard part and living through the highs of lithium, I see a lot of similarities on how rare earths are behaving. It's a small market. It's niche. The actual getting product out of a deposit is very complex. It's not, the products are not just, pick, like, oh, let's take it now. There's 17 different rares. There's some of them like to be together all the time. They don't, or most of them, they can't get separated very easily. So the sort of processing aspect of the business is really specific and different. So, and it can be mostly different for most deposits. So I think that's something that is really, really interesting and in both. And in terms of and also we're bullish on those three despite long term. So this is going to, in the meantime, there's going to be sort of weakness on the side of lithium and uranium at times, and in the side of rare earths, because of what's happening now in the US, we have seen volatility. So it's rising, but it's volatile. Like, you don't know how long that's going to last, so you have to be careful. But long term, those are going to be. So those would be my views on those. And on lithium, I think we're going to start seeing a recovery. I think we saw a little recovery, so it's a mini one, but I think something more meaningful is coming within the next 12 to 18 months.
Okay, excellent. And so, I mean, a lot of these are kind of considered some of the critical minerals needed for the energy transition. And there is definitely, significant investment needed to kind of spur on more exploration and development for these types of projects. So what would you say are ways that we can kind of work to attract that investment needed?
I think more generally, we need more generalist investors to come to the space, because they're just like, if we were to achieve the goals, the critical minerals goals that have been set, we can't reach them unless there's a lot more investment. Like, we're talking trillions of dollars invested across multiple years. And so I think we need more generalist investors and that means that we also need more ETFs and sort of those types of wrappers that can allow people that are not interested in doing terribly deep research that you need to do on a mining company to understand, especially exploration. If you don't have revenue, and that's another basket case, if you don't have revenue, how is a generalist investor, assess risk in a way that doesn't say no because it doesn't have revenue. So I think the ETFs and that sort of alternative is really important to get more people in. And at the same time, you need more ETFs that are bigger. So you need to include all the types. You need to have the mining sector, but you need to have the rest of the supply chain. You need to have, from the downstream, the upstream to the downstream. So you need the whole cycle to really to ensure that you have cash flow so that you can get those generalist investors. So I think that would be a way. So it's not getting deeper, it's getting wider. That's what I think.
Yeah, that makes sense. Absolutely. And then kind of looking specifically at the Australian market. So, do you see big growth opportunities for juniors operating here? And, with regards to investment, is that coming predominantly from Australian investors, or is it more global?
I think we're seeing a lot of, and this again connects with what I was saying before, we're seeing a lot more sort of waves, like, one market is not doing as well, so then the companies try to raise in this other market, and then the other market recovers, so they go back. So, and there's a little bit of a dance there. But right now, I think we are seeing Australia is kind of seen as a better alternative than Canada at the moment, and this will vary. Some companies don't have any issues, and you're going to see them fine. But I think the Australian market is giving a lot of options, is giving a lot of potential for growth. There's still a lot of growth here, and the Australian investor still has more. It has the sort of capability in general of taking on more risk, which is something that is not as common elsewhere. So I think that's a really cool aspect of the local scene. And even at the sort of more bigger institution, you still have that sort of, oh yes, appetite. I can do a little bit of. So I think it's a good market. I think we're going to need to see lithium better because it's a big part of what we see here. So it needs to improve, but I think it's going well.
Okay, excellent. And then, along with that, just to kind of wrap it up. So thoughts on the next, say, let's go with 24 months or so, are there kind of key trends that we should be on the lookout for?
The main thing that I'm getting a feel, because you get these sort of feelings. It's of course backed by what you're doing, but you kind of our brains and our nervous system is so advanced, like we don't even know exactly how it works, but you absorb all these things that you're reading and you're knowing and you're working, and I think right now, going back to the rare earth bit, I think within the next couple of years, there could be a similar market than lithium in 2022 building up. Like you already see in the valuations. And of course, if you're listed in the US, you're going to get a lot of generalist investors coming in. So should really take attention. I think we're going to see growth, and it could be as big as lithium. It could be, half of that. It's still, if it's half of that, it's still, huge. So I think that's something big, and there's also, and we talked about why, like the similarities is just because they have similar characteristics, and the other thing is a lot more companies that are trying to find quicker way to cash flow, and they're doing that by either attaching, and this could be in rare earths or other things. It's happening a lot in rare earths. We're seeing tech companies that have a mining project. They call themselves a tech company with projects or something like that. I forget, like one example, I forget what's the name of the, anyway, I forget the name now, but we have like 20 peers, and this some of them that are doing that are calling themselves tech companies with them. I think we're going to see more of that. Of course, it's not new, it's not completely new, but it's new in the smaller slide of the scale for size in terms of market cap. So yeah, I think that would be so rare earths and more companies having mines, but not calling themselves a miner.
And that's really interesting. And I think, I mean, I think it makes sense. There's to kind of, I suppose, diversify for investors, kind of the outward appearance of what the company is and kind of what their impact could potentially be by calling themselves a tech company. So that's quite interesting. Definitely something to look forward.
Yeah. If you look at the MP Materials website, that's one example. They don't. I mean, I can't remember exactly, but it's not evident. It's not as evident. And if you look through, looking for the resources and reserves, like in general, that sector is not as easy to find because I think they're going through that transition. So yeah, we'll see. We'll see what happens.
Excellent. Well, Paola, I want to thank you for joining us today and sharing your insights on the market. It's been very interesting. But those were all the questions that I had for you today. So thanks for joining us here today.
All right, Jamie, it was a pleasure talking to you as always. And I hope you have a lovely rest of today.
Thank you. You too.